Welcome to Between Two Stops, your ultimate podcast for diving into the latest trends and topics in the pool service industry, bringing you insightful conversations with the best and brightest industry experts, inspiring stories from successful business owners, and educational insights to enhance your skills and knowledge. Buckle up. Between Two Stops by Skimmer starts now.
Welcome to Between Two Stops. I am your hostess, Niki Acosta, and my guest today probably doesn't need that much introduction. If you have been following our webinars or tuning in to some of the content that we've been putting out at Skimmer, I've had the pleasure and the honor of presenting with Casey Graham on more than a handful of occasions, and he is one of the brightest minds in the pool industry. That's my opinion. You can form your own after this podcast, but Casey, welcome.
Niki, I love the intro. Can we get the video clip of us dancing and send it out?
Okay, maybe I'll leave that in.
Oh my gosh, that was so good. Thank you for having me, Niki. It's always fun to be here. We'll be in Austin next week with your team. You will sadly not be there, but you're one of my favorite people in the industry, and thank you for what you do.
Oh, thank you, Casey, and thanks for joining us today. The reason why I wanted to bring Casey on is because we have just launched a book with Casey that he authored and flew to Austin to record as an audiobook as well for those of you on the road, called From Skimming to Scaling. And what the book does is it shifts your mindset into thinking about how your role as an owner changes as you grow and scale your company. And we did a webinar about this, so we don't have to go too deep into it. If you want that resource, it is available on the Skimmer website and it's free. But Casey, tell us about why you wanted to write that book to begin with.
Well, when I entered the industry a few years back, all the other industries that I'd been a part of, because I'm not native to pools, or I'm not a pool guy, or my granddad wasn't a pool, like I was the complete opposite, right? Just coming in fresh and new from technology industry, from all these other things. And there wasn't resources as like there are in other industries. Like in a lot of other industries, you got so many books. You can go to Barnes and Noble and find how to grow your business and scale and real estate and, all these different things. And it wasn't readily available. And, we kind of went through it and did it our way. And I wish there would have been a guide saying, not that it's prescriptive in saying that this is how it's going to be in every business, but here's some of the things that could happen and how it looks, and maybe some of the hires you should make, or maybe how you should structure your finances different because of this industry is different, or, those kind of structural things and business growth things and mindsets and what the role of the owner is as the business grows. I just thought it'd be good to give a little bit of perspective on maybe learning from other industries, bring it into this one. And then we experienced it. And then we just wanted to give it back. And obviously it's a free resource that, again, it's not saying it's not perfect, but it is kind of a good little guidepost to show you where you are. And if you do want to grow, here's the key things you got to do to get to the next level.
And I love that. We went through the 5 stages, which are based on revenue stages and, ostensibly the number of pools that you're servicing. But you take folks from going from the path of being, an owner as a doer to a driver to a delegator to a decider and to a designer, which I think that's where a lot of folks, fall flat. I will say one of the things that I admire about you a lot, Casey, is your appetite for risk taking too, passionate risk taking. There are a lot of folks out there that may not want to grow their business and are completely happy running, a single pole route, and kudos to those folks. But I think there are a lot of other folks out there that want to take their business to the next level, that want to get off the pole at some point, that want to be able to have other people handling stuff in their business so that they can take a seat back and work on whatever it is they want to do in their personal lives or on growing the business with a team in place.
Yeah. Yeah. And I would say, as we get into what we're going to talk about today about building value in your business, and then building a business that if you wanted to sell, if you wanted to exit, if you wanted to, have liquidate, because owning a business is one of the greatest ways to create wealth for you and your family if it is done correctly. That's great. However, if you don't want to do that, we call it owner's intent. That's the first part of this whole, the whole skimming to scaling book is don't do it, right? you don't have to do it. Like, it's your life, it's your business. And if you want to clean 50 pools a week and do that and, know all the customers and make all the money yourself and not have to deal with employees and however you want to do it, that's totally fine. There is no right or wrong. But the reality is what we found is that a lot of people say, I want to grow my business, which is true. But the reality is just because you want to grow your business doesn't mean that you want to grow. Meaning, you are the bottleneck to the growth of your business. I am the bottleneck to the growth of my business. And growing a business isn't about the business. It's about the person that's leading the business. And the business will only grow at the level that you grow. And to grow, there's pain and there's change. And I've got the way I think it needs to be, needs to shift sometimes. And that's where we see, I guess the tension is people want to grow their business, but oftentimes they don't want to grow. So you got to make a decision. Yes, I want to grow my business. Yes, I'm willing to change. It may be painful. I may have to see things a different way than I see them. I may have to give up control. No, you will have to give up control, right? So the larger your business is, the less control you're going to have personally. And so those are some of the things that we'll talk about today about how to create value in your business. And we'll give them kind of a roadmap of how to do that.
I've been on the road, Casey, with the Skimmer Roadshow, talking to pros from all over the country, and your content that we've done together, the webinars in particular, have been a topic of conversation. And I like to ask people, what was your takeaway from those webinars? Like, what is the thing that really stuck with you? And for a lot of folks, it was that piece on letting go of control. Like, you cannot be good at everything, right? And you are going to have to hire help, and you're going to have to be okay with knowing that someone is not going to do a particular task as good as you do. They might do it 80% as good as you do, and that's okay.
Yeah. It's the truth. It's the more you control of the business personally, the smaller your business is going to be, and usually the higher your stress is going to be. So, it's just a choice. And I don't look down on any of that. And that's the thing I think everybody needs to realize is if you choose that path, great. Turn the podcast off and just don't do anything we talk about. But if you do want to be somebody that wants to grow your business, wants to create a valuable business, and then maybe one day exit or sell your business for life-changing money, then do what we talk about today.
So, Casey, 100%. One of the things that I've sort of run into, and I've seen the same feedback coming back to other guests we've had, is this attitude towards people who are buying their way into the pool space, right? And so you've got tons of people. There was a company that we met last week that came to our office. They've got 1,000 pools. They've never spent a dime on marketing. They've owned the business for 17 years. They have provided excellent service. They have created great standard operating procedures for every part of their business. They've got, an HR person on staff. They've got coaches on staff. They've got, service and repair managers. I don't want folks to think, and the reason why I bring this up is that the only way that you can grow your business is by buying your way into it. That said, what you are building is valuable. And so, Casey, one of the things that we wanted to talk about today was, how do you build a valuable business? How do you build something that is worth a lot of money to somebody else? Mm-hmm. And so I know you brought a checklist with you. So
and
you, right.
That's the key. So building a valuable business, whether you sell it or don't sell it, right? You're the beneficiary. So I'm always like, if I'm going to spend my time doing something, and let's say I never want to sell it, and let's say that it's a generational business and I'm going to pass it down to my kids and maybe they pass it down to their grandkids. You still want to build that business in such a way that if somebody else owned it, that person would pay a lot of money for it, because that means that it's worth that much for you to own it, right? And so that's what I always get at is people that they start trying to clean their business up or starting to build it the right way or the way that's most valuable to somebody else only when somebody else is interested in it. And I say, that's not the way to do it. Do this no matter what. And then you will be the beneficiary of that valuable business, which means you'll build a scalable machine that operates without you. And if you want at that point to go clean 50 pools a week in that business, you can, but you don't have to, right? And so that's what we want to talk about today. So the first question and the genesis of us getting together was, the number one email I get is I get emails. They're like, hey, somebody reached out to me and they're interested in buying my business. And like, I just want to get your perspective on like, what my valuation is going to be. And that's the number one question I get is, how much is my pool business worth? Right. And so they want to jump on a phone call usually. And then they tell me, I have this many pools and this is about what our revenue is. This is about what our profit is. What do you think my business is worth? Right. And they think it's about how many pools you have and how much revenue you have and how excited you are about your business. And the reality is, that business could be worth 3x of the net profit, or it could be worth 7x of net profit, right? But there's about 40 other items that make the difference. And so it's not as simple as tell me the valuation of my business. Your business is worth something based upon an actual checklist that the group that's going to buy your business is going to take you through and look at it. And it is, no matter who you sell to, the people aren't just paying hundreds of thousands or millions of dollars just because of a pool count, a revenue size, and this is what your profit is that you say it is. Does that make sense, Nikki?
It does. And I do think, I see it all the time on online. Someone will say, I'm thinking about selling my route. I've got, 50 pools, what is it worth? And, various people chime in with different opinions. One of the things that I've learned about just sales in general, and especially coming from my real estate background, is your business is worth what someone else is willing to pay for it.
Mm-hmm.
And if your business is great and it's healthy and it's functioning and it's running like a well-oiled machine, there is somebody that is going to find that valuable and pay a premium for that.
Yeah, but I want to be specific. Okay, so here's how I have viewed it, and then other private equity groups that are in the space, how they view it. And it doesn't mean that this is right. It just means this is what I'm seeing as it relates to the data being true. So if you're selling you said selling a route, that's what the pool industry used to be full of, is everybody thought I'm selling a route, right? So there's two different versions of selling a route. There's when you sell your accounts, meaning you just sell the customer account and you're going to have to provide all of your own cleaning, or you're going to have to be the cleaner and the repair technician, all this kind of stuff. That's worth the least amount of money. And the average, we see some of those go for 6x of MRR, which is monthly recurring revenue. So let's just say that route it makes you $10,000 a month in cleaning. You can get 60 grand for that, right? Up to 80 grand. So somewhere in there, that's what we see go as a going rate currently. Again, that could change in different parts of the country, maybe higher, maybe lower, but then that's selling a route. That's what we see a lot of times. Now, if you're selling a route with the workers, right? It's worth more because it's coming with that, and maybe you get the trucks, and maybe you get some of the cleaning equipment. We see those going anywhere from 9 to 12x of MRR, so monthly recurring revenue. So that $10,000 route, be worth 100 grand to 120 grand on average, right? It doesn't mean that it's that way every time, right? So that's usually the size in which people are selling routes, and pricing is in that range where you're under $1 million of top line revenue. So that means that your total sales of cleaning and repair would be $1 million or under. That's oftentimes what you're going to see as it relates to valuations, and that's kind of how it's going to feel. So I'll stop there. That's where most pool companies are. And then the next question would be like, well, I heard, and they go online and they Google, what is my small business worth? And then they hear terms like, you get a 3x multiple, right? And then it's like, on what? Well, that's on what they call it's net profit, or EBITDA, right? That's our seller's discretionary earnings. That's money that after you pay all your expenses, that's free and clear. And so let's just say that you've got a $600,000 cleaning and repair business, and you've got $200,000 of EBITDA or net profit. Then somebody's going to come in and they're going to put a valuation on that business, which is usually going to be 2.5 to 3 at that smaller range. And so you're going to sell that business for $500 to, $650,000, somewhere in that range is where you're going to sell it, which if you went back to my old math is 12x. It's one-time sales for a year. So if you're 600,000, you're throwing off 150, $200,000. That's probably where you're going to get an exit valuation in that type of range, right? Now, some people will say, well, I got a 5x. What does that mean? It means that somebody came in and they valued their business more. And the reason they valued their business more is maybe that owner is staying on and running the business, right? Maybe the team is maybe that business is a growing business at $600,000. It's not stagnant. And this time next year, it's going to be $750,000 top line, right? And so there's different levers in which groups that are buying businesses look at to put a valuation. And the better the business is from the time that it's bought into the future that they can predict with the less risk, that's where they will pay you more. And that's where the whole valuation comes in of, are you a 3x? Are you a 6x, right? And that's usually where these businesses trade is in that 3x to 6x range on average. I have seen some that are extremely higher than that. I don't see very many lower than that, but that's the average that we see. Now, Niki, I'm going to stop here because I'm throwing out a lot of numbers and this X and 12X multiple and MRR, but these are the two valuation metrics that most people are looking at when they're going to buy either a route or buy a business. What's your thoughts or questions? Or if you're listening to this and you're a pool guy and you're not a financial guy, right? What would you be thinking or questions that you would have around that?
I would be asking, based on what you just told me, how do I build a company that is more valuable at the top end range that you just mentioned?
Oh, good. Well, we've got about 40 different items to talk about. You ready?
Let's go.
All right. So I want to bucket these into 1, 2, 3, 4, 5 categories. So when we build the notes for this, or we build like a graphic, or we build something off of this, I think it would be powerful for people to see the 5 buckets. And then each of the buckets, maybe you have like the click down, right? Of inside of those buckets, here's what it means. So the first one would be what we call deal dynamics. Okay. So what does that mean? It means the first thing would be, what's the reason you want to sell the business? Right. So if I talk to pool business owners all the time, and I talk to a guy, let's say he's 54 years old. I get on the phone with him and he's like, oh man, I've been in the industry for 30 years. I'm just so burnt out. Immediately, I'm going, lower the valuation. So he's burnt out, right? Like he's, and I know then the next question is going to that I'm going to ask is like, well, what's your future plans with the business? I want to get as done with this thing as soon as possible. I can't wait to get out of it, right? Those kind of things. That would be a reason for the sale is I'm burnt out and I want out of it. So I start lowering the rating on what I'm going to pay this person for their business, because I don't want to buy a burnout owner's business that then I've got to go put money in to have somebody manage and run. Make sense?
Totally.
Now that same person can sell to an individual that wants to replace them in the business to come into the business and run that business and take their place and not be burnt out, but they're not going to get maximum valuation if the reason they're selling is I'm burnt out, I don't like it, and I'm tired of it, right? Now, another reason for sale would be I'm in this market and we got 700 pools. If I had capital, we could grow this thing to 3,000 pools. Now, when I hear that, I'm like, take the valuation up, right? His reason or her reason to sell is I'm not selling so I get out. I'm selling so that I take some what we call chips off the table, put some money in my pocket, but I still want to be on for the future ride because I want to grow this thing and I don't hate my life and hate the business and this kind of thing. So that would be, Niki, that's one reason, right? A reason to sell. Another one would be, does the company have quality data upon request? So, right. So this is part of the deal dynamics. If this is run out of your truck, out of an office, and it's pencil and paper, and you can't get quality data over to me or over to our group or over to a group, and if the data that you send over, we have to put it all back together and make it all work and all that, lower the valuation. If you have quality financials, if you have quality taxes that you've been paying, if you're not just trying to run all of your personal expenses through the business and it's all jumbled together and you have all this explaining to do, right? And it's all separated and it's nice and clean, valuation goes up. And so again, that's another level of like, what is the quality of your data? Who is running that? And what does that look like? A lot of people, you can just email me, Casey@yummypools.com. I can literally get on the phone call with you and I'll tell you, here's how you need to structure your data. And maybe we need to put a blog up on that. And it's called, right? And there's different categories. Here's my legal documents, right? Here's my financial documents. What type of financial documents? And then I could go to, right? We don't have time today to go into all of that. That's a 2-day thing of going through everything and making it all perfect. But I could tell somebody on the phone exactly how to do it. But you want to have quality data upon request. And then the third one I would say inside of deal dynamics would be seller valuation expectations. So most of the time I get on the phone with somebody who wants to sell their business, they've made up in their mind what their business is worth. Just made it up. And so you talk to somebody and let's say they got $1 million cleaning and repair business, it's throwing off $200,000. And they say, I want $3 million for this business. I'll sell you the business for $3 million. Immediately, I start going lower valuation, lower chance, because this person has no clue what they're talking about as it relates to how a business is valued. A business is not valued based upon what you think the business is valued at. Now, that's what you will sell it for. That's different than what the value is. The value is what you said, Nikki. It's what somebody will trade you for and give you cash so that you get out of that business, right? And so seller valuation expectations. So if I'm listening to this podcast, if you get on a phone call with somebody and they're peppering you and asking you like, well, what do you think about this business, or what's your expectations? I would never answer that question directly, and I would put it back onto the person that is looking to buy the business. And I would say, I am happy to sign an NDA and give you some data and let you tell me what you think my business is worth, and put it back on them. When somebody says that, I respect that answer way more than somebody's throwing out a crazy number. So that's the deal dynamics bucket. And those are like when we get on a phone call with somebody, those are some of the things that we're going to start talking about, like very high level. And immediately we start going higher valuation, lower valuation.
When you're out looking at these companies, to potentially acquire, Casey, is there a minimum sort of deal size that you're looking for in terms of either, size of the business, revenue, pool count, whatever that is?
Well, for our group, which is different than every group, right? So for our group is we want to buy a regional hub. So we're looking for the right market, the right regional hub, and a business that's got, some size. It's got some scale to it, right? It's going to be in the multi-million dollars most of the time as it relates to a regional hub. So then after that, down from that, we have route acquisitions. So if we have a regional hub, we can buy a route. We're not going to go to a city and just buy a route, because I can't run that business from here. You've got to have the leadership team in place. So there's the regional hub, there's the routes, and then underneath that, there's just accounts, right? You may get opportunity just to buy some accounts, throw them into your business. And so those are the three things. Now, that's our group. Other groups it may be a private buyer, and they're just saying, hey, I've made money in the corporate world. I'm tired of it. I'm 45 years old. I've got $400,000 and I'm going to go buy a route, right? You could sell that route to somebody. And then there's different reasons for different buyers at different points. But there's an institutional buyer that's doing consolidation, and then there's individual buyers that are buying individual businesses. Does that make sense, Nikki?
It does make sense. And what I will say is that I have seen a lot more of this happening in the past.
Which one?
8 months, both, right?
Both.
I've seen folks going into an area, buying a larger business or investing in a larger business or partnering with a larger business, and then building out that local presence via route acquisition. And we're seeing a lot more of that than we have in the past. And I know it's already happened to lawn care. I know it's happened to pest control.
Yep.
And you and I talked at length about why pools are different than either of those two industries.
They are.
But it's happening. And the way I like to tell, folks who are feeling a little bit uneasy about this, and I think we talked about this in our webinar too, is, this can actually play to a benefit to you as well, right? Like if you're a small company and you pride yourself on giving your cell phone number out to every one of your clients and you're a boutique provider, great. If not, if you want to, build a big business that can scale and grow and, take on some private investment to make that business even bigger and still have maybe a role within the company, but less involved where you've got operational expertise behind you, that's great too.
Yeah.
Either way, it's happening.
It is. Yeah. So whether you want it to happen, or that's what, people online get mad about or not, it's America, right? I mean, it's free market. People are going to do whatever they want to do, regardless of what you think should happen or not happen. And so, private equity currently and consolidation, I would say we're in the second to third inning of a 9-inning baseball game. So we're early in that, right? I think it first started, the first investment was the end of 2020. So 2021, it started heating up as private equity groups started getting cold on technology, and that technology bubble kind of popped. They came back and swing back. And the thing about private equity groups that a lot of pool owners, you're listening to this, you're going, why are they doing this? Because they have to, private equity companies take money from investors, and they have a legal mandate. They have to invest the money. They can't just keep the money. So they find markets, and once they find markets, they flood the markets because they start, they've got to deploy the capital. And once you see one private equity group come in, you'll see 2, 3, 4, 5, 6, 7, and it just starts happening and it starts multiplying. And so that's where we are. So that leads me, can I get back to how to build a valuable company, Niki?
Please do.
The second one would be the financial profile of the business. I'll go high level on these. Revenue size, $1 million and under, your valuation is just going to be less. Period. There's just a threshold that happens at 1 million. And for perspective, I'm just talking cleaning and repair. What we see and what most construction and expensive renovations are not very valuable they're valuable for you as the owner, but they're not very valuable for the consolidation that's happening. Most people do not want that as part of their profile. Most consolidators just want pure cleaning and repair businesses. They don't want those big episodic swings in the business of construction and renovation. So if you're if you're $1 million or under, it's going to be on the low end. 1 to 3 million is kind of a sweet spot. You'll see a lot of really good businesses that are really healthy. You're going to be in the middle range of valuations. And then if you're over $3 million, you're going to start, getting on the top end of the valuation. Now there's some juggernauts that are, say 10 million or 15 million or 20 million. They're in their own stratosphere and they're not even worth talking about because there's so few of them, it doesn't matter. But your revenue size will make a difference on your valuation, right? So just because somebody got a 6X in the pool industry, if your business is 750,000 and theirs was 3 million, just because they got a 6X, you're not a comparable business to that business. It's like buying a 2-bedroom, 1-bath house versus a 5-bedroom, 3-bath house. It's just not the same, right? So that's revenue profile. That's one of the categories. Another is the EBITDA profile is attractive. EBITDA, earnings before interest, taxes, depreciation, amortization, right? Look up the term, EBITDA. I know I'm from Alabama, so it's hard for me to understand. Look up the term, understand it, but essentially it's going to be what they call seller discretionary earning and or true net profit, meaning income comes in after all your expenses. Here's how much is left over, because essentially that is what the person is buying. Okay? If you're under $250,000 of EBITDA, you're going to be on the lower end of the valuation scale. If you're 250 to 500, you're going to be in the middle. And if you're 500 above, you're going to be on the top end. So hopefully I'm giving people kind of, standards to know here's where I am. And this is what I can expect if I want to build a valuable business. So you may be at $300,000 of net profit now. It may be worth you building the business or buying a couple of routes, juicing up your EBITDA to get to that 500 number so that then you can command a higher exit valuation because your business is worth more for somebody. And oftentimes I see pool owners, they think that like groups don't want to pay them a lot. It's actually the opposite. Private equity groups like bigger businesses with bigger EBITDAs, and they will pay more for bigger. And the question is why? It's not about the money, it's about the risk. A business that has $1 million of EBITDA that's well established and doing extremely well over a 30-year period is way less risky than somebody who's bought 4 routes, put them together, and then trying to take that business to market in 18 months, right? Those are 2 different animals. And so that's EBITDA. Another part of the financial profile is your MRR is consistently growing year over year. So your monthly cleaning revenue needs to be growing year over year over year. Very important to show, keep up with that. And so you can see it. Let's see. Another one is your repair revenue has a strong margin. So a big thing that you're going to want to show, and a value that you're going to show, is your margin profile on here's how much money we make on cleaning, here's how much money we make on repairs. And you can actually separate those buckets out and show that, like, on our repairs, we're at a 50% margin, or we're on this. And on cleaning, we're at a 25% margin, whatever your different margins are. If you can show those to the group, it creates more value in your business, right? Insurances. Here's another one. Niki, this is just about every business that we buy does not have the right or proper amount of insurance on the business. Do you know the reason that they don't have the right and proper amount of insurance on the business, Niki?
No, but I think you're about to tell me, Casey.
Because it's expensive and sucks.
It is. Fair.
But here's what a lot of owners don't know. When a group, am I getting too detailed, Niki?
Nope, not at all.
When a group comes in and evaluates your business, the first thing owners like to tell me is, like, I'm making $500,000 a year out of this business. Now, that may be true for them. That's not how the group is going to evaluate your business. They evaluate it looking after they buy it, and they put proper insurance in place. And they're not going to keep 1099 workers because it's illegal to do so at scale. So they've got to convert them to W-2 and add the taxes in. They create a pro forma into the future where they add their real cost of what it costs to run the business the correct and proper and legal way. And it lowers that amount down to, say, $350,000 is what we're going to make off the business. And so the owner may say, I make 500, and they're going to want their valuation on 500,000. That's not how the business is going to be evaluated. The business is going to be evaluated on, after we buy the business, we've got to have the right things in place. You're at 350, and then a lot of people get shocked and sad and surprised. So if you cheated up front and you're taking that cash out, it's fine. You can do that. And I'm not saying what you're doing is legal or illegal. That's up to you. But if you want to keep all that cash and play games, you'll make your money there. But if you want to have everything done correctly, you'll have the correct insurance, workers' comp insurance. You're going to have an umbrella policy in place. You're going to have all of the right insurance coverages inside of your business as a line item. And it's a big line item that we're going to add back in part of valuation. So that's the second category, and that's the financial profile. Those are things that we're going to be looking for, or any buyer's going to look for. So, Niki, any thoughts on that?
Yeah, I've heard of folks that, acquired businesses that had undocumented workers underneath,
Yeah.
and it was a huge blow to try to replace those folks and get them, on the up and up, and it was incredibly disruptive. I've also heard of businesses that will not hire folks under a certain age because the automobile insurance becomes
Correct.
exponentially more. I don't know I think it's like 21 and under or something. If you've got, a business that you're trying to run, and you're looking at trying to insure, specifically men under the age of 21, it could be sometimes twice the cost as someone who's going to be a little bit older. So all those things certainly play a factor, and it's just, it's the world we live in.
Yeah. So let's go to the third bucket. You ready?
Let's do it.
Is this too detailed? Tell me.
No, it's not. Keep going. This is gold, Casey. Keep on going.
Operations. A data point that we're looking at that's going to put you on the low end or high end evaluation is your average employee tenure. How long have they been there? Right? If it's a turnover fest, it's going to ding your valuation. Why? Because that creates risk. Because as employees turn over, we've got the data that shows the more turnover there is in the technicians, the higher the churn is for the customers in the business.
100%.
Now, caveat, I've run a pool business. This is the hardest part of the industry. Like, so I'm not saying it's easy. I'm just saying like it matters and it's super important. And so the buckets we're going to look at is you put every employee and you'll go, if it's a year or under, that's a ding, right? That doesn't help you. 1 year to 3 years puts you mid-range valuation, and then 3 years and beyond puts you at maximum valuation on team. Then there's employee churn. What does the churn rate look like for your employees? Like how fast are you churning people over? Again, if it's a 30% churn, where you're turning over 30% of your workforce every year, you're going to be on the low end. If it's a 10% churn, you'll be on the high end. Employee certification levels and training. So if you're like an owner that goes out and you train all the new people yourself, that's not very good for valuation. What's good is I've got this person or process. Here's our training process. And when you're talking to somebody who wants to buy your business, what you literally could do, if you can send them a Google Drive and say, here's our training checklist, here's who does it, and here's the videos that they have to watch, and here's the checklist, and here's the system, valuation goes way up. If it's just all tribal knowledge and everybody kind of just learns from somebody else, you're gonna get dinged on valuation. This is a big one. How do you compensate your employees? This is a big one. So we are W-2 and do everything W-2. If you have 1099s, it's going to be a huge ding, or they may not even buy the business in a lot of ways, because that 1099 worker, there's just all these legal laws and stuff around it to where, if you're going to build a business, you've got to do things that by the book, and especially bigger groups, they've got to do it by the book. They're not going to buy, if you've got a business with 10, that may be fine for you and you can justify it or not justify it, but for somebody looking at your business, it's not going to work as well, right? So what does that structure look like? And what is it comparable on the market wages? So a lot of times we go and look at a business and they're paying under market wages to their employees. So if I'm going to buy that business and let's say they're at 18 an hour and we're paying at 23, as soon as we buy that, these people start talking to these people and we're going to have to bump them from 18 to 23, period. So what we have to look at is, what do we pay? And then when we're looking at the business to evaluate it, we evaluate the net profit of this business, not based upon what you're paying if you're underpaying people. So you may be underpaying them and making more profit, but we got to evaluate them based on what we're going to pay them and what reality is going to look like. Does that make sense?
It does. I mean, look, retention is a big problem for a lot of full service companies. There's a lot of options, right? Like, if you've got a pretty decent skill set, all it takes is for someone from another company to say, hey, if you come and work for me, I'll give you a tighter route and $3 more per hour. And that might be enough to steal that person away, right?
That's right.
Assuming that person is money motivated, which, most people work for money. We did talk about other reasons why people work for companies, which we won't get into here today because we covered it on, I think, our first webinar we did together, but definitely a focus on retention is huge. And if you are having, burnout in your business, I would say, it's time to take a look at what you can do as an owner to make sure that you are incentivizing the right behaviors, compensating people, and creating an environment that people want to work at.
Yeah. Let me give you 3 more real quick. There's more, but I'm just going to keep it simple. What system you use, technology stack, is huge. Okay. This is a Skimmer webinar.
Podcast. Yes. A Skimmer
podcast.
It's an industry podcast, Casey, but if you're going to go ahead, say some good things about Skimmer, I'll take it.
Well, the most powerful map that you can show somebody buying your business is your route density. So pulling up that Skimmer map, I mean, I can't tell you how many, like when we were looking to sell our company, the ability to pull it up and show the dots in a pretty screen, like of how close these pools are to each other, and to have the list that showed that they're this far from each other, and like that is gold as it relates to selling your company. And so having all of your data inside of Skimmer or the system that you use, and the route density portion of that, and showing it, and then showing integration as it relates to billing, and then showing what your pricing is on your chemicals, and then having all of that inside of one CRM and one software versus, oh, Betty does that on that spreadsheet and Tommy does this on this thing. And he doesn't even have a spreadsheet. He keeps notes in his phone. Like, taking the time to get it all into Skimmer and making full use and hiring somebody, even for a 90-day project, to come in to take all of your data and to make it all cohesive and sync inside of Skimmer is going to increase the value of your business significantly. Because when they buy that business, they're buying the platform and they're not buying all these random spreadsheets and they don't know where stuff is. That creates risk. And so that's a big deal, right? When you do your billing makes a difference on valuation. So when do you think the people that are buying your business want to do the billing?
In advance.
At the beginning of the month. And then the old school industry says you can't do that, right? You got to wait to do the work and then you get paid. It's not true. Like, we've got thousands and thousands of pools that all get billed at the beginning of the month. So you can do it. You just have to do it and know that, like, if you do that and you bill up front and the automation that happens in Skimmer and you get all the money in on one day, that is way more valuable than chasing invoices and checks and all that. So then that goes into the next thing is, what is the payment method? So when a company comes in to evaluate their business, they're going to do literally a chart, and it's going to say, you take this amount of payments digitally and they're automated, right? 60%, 20% are checks, and then 20% are some other form of, payment, whatever. And so having that bucket at 100%, if you're listening to my voice, I would do this no matter what. Just tell your customers, hey, we don't take checks, and all the billing is done up front, and it's all automated. And 95% of them will acquiesce to it. 5% you may lose, and you're going to think, I'm going to die. You won't die. And that 95%, having it organized, structured, and all that, is not only good for somebody buying the business, it's good for you. It keeps things simple and organized, and you're not chasing invoices. And then, obviously, last but not least, would be a clean legal profile. One of the things that is going to be asked when you're to sell the business is, do you have any lawsuits or legal? That's why because people don't understand why people don't like construction. Lots of lawsuits in construction, renovations, those big ticket, big thing items. And so having a clean legal profile. So that's the third bucket, which is operations. So we talked about the deal dynamics, the financial profile, operations. And then the last two buckets are, the services you provide, like your customers. And then the last bucket will be kind of your founder, team, culture. What does that look like? And so, Niki, do you want to go through those, or are we too long?
I think we can go through them briefly.
Are you sure?
Hey, if folks are still listening at this point, then good on them. Go ahead and share.
Well, the goal of this was to be comprehensive, right? And if somebody is interested in selling their business, they're going to be interested. If they're interested in building value in their business, they're going to be interested. If not, they're long gone. When we were talking about EBITDA and all this other stuff. So the fourth bucket would be your services and customers, right? Cleaning and repair revenue. If it represents 75% or less, meaning you've got other revenue streams, you do pressure washing or you do construction or all this kind of stuff, you're going to get dinged on valuation. The closer to 100% pure cleaning, pure repairs, the higher your valuation is going to be. Niki, that is non-negotiable.
Do you have any sense, if there is a service customer that you're servicing regularly, do you have any estimates on what a good repair revenue looks like on a per customer basis?
Across the board, like if we're looking at a company and it's like you've got like awesome would be like 60-40, it could be 50-50 too, that are really good at repairs.
60 repair, 40 service, or 60 service, 40 repair? No,
60 service, 40 repair.
Okay, got it.
Okay. So like one where we would go like, oh, that's low, would be like 80-20. 60-40 would be awesome, somewhere in that range, right? Even a 50-50, like, hey, we crush it we have cleaning, but then we have because repair is oftentimes where most of your margin is and a lot of the profit is. So, right. But that's what I would say, anywhere from 50 to 65%, I would say is awesome. Your price per pool,
Mm.
you get paid more if you price higher than if you price lower. So your valuation when you're selling your business, and so you're worried about churn because you're scared to increase your pricing. But the reality is that your business is going to be worth way more than any of the churn would have happened if you would have just got rid of the low paying customers. And so you want to price at the above side of your market, not the middle or not below, even if you have less customers, because you'll have higher margin. This is a huge point, Nikki. I know you see this all the time.
We did. And I will say, being out on the road, I did hear from some folks that followed your methodology in increasing their rates and were absolutely delighted that they had so little churn. Like if you're providing a good service and, especially if you're like small and all your customers on a first name basis, don't be afraid to raise your rates. Like everything is getting more expensive. Everything,
Yeah.
they're used to it. And if they love you and they value you, great. Worst case scenario, they might go shop some other people. They might get a bunch of people that don't call them back. They might get pricing that's actually higher than yours, but it's worth the risk, I think.
Yeah. Yeah. Another valuation driver is going to be seasonality, right? The lower the seasonality, meaning the year-round open pools where you go every single week, is the most valuable. Bi-weekly customers are really despised by people that are buying a business. And the worst type of customer is the seasonal customer. I'm talking about from a valuation standpoint. I'm not saying you don't need to do it. You may be listening to this and go, I live in Minnesota. Well, you're going to be seasonal in Minnesota, but it will hurt your valuation. So, right. We need pool cleaners everywhere, but the year round open business, weekly service, cleaning and repair, keeping it clean like that, obviously very important. Customer churn, the number one metric that they're going to run is a customer count churn, meaning when you started the month, you're at 100. When you ended the month, you're at 103. You're net adding. If you start the month at 100 and you're at 97, net loss on customers. That's one metric they're going to run. Another metric you're going to run is revenue, meaning if you're at 100 customers and you've got $100,000 in revenue off the 100 customers, but even if you increase your prices and you go to 97 customers, but your revenue goes to 105, they will still see it favorably because yes, you churned customers, but you increased your prices, or the new customers that you did add were worth more than the existing customers. And so they're going to look at a revenue churn and they're going to look at a customer count churn. Those two numbers are extremely important to keep up with. If you don't keep up with, if you just showed that number, that's probably going to be, and you say, why was that number matter above all numbers? Because they're not buying your current book of business. They're buying what they're projecting your book of business is going to be in 12, 24, 36 months. And so if you're showing net new growth on revenue and net new growth on customer ads, then your business is going to be significantly worth more to you and to somebody buying it, right? So strong reputation and reviews. I'm going to call every other week where we bring businesses and we look at these businesses. And one of the first things that everybody brings up that's bringing to pitch a business that they found that they want to buy is they have 335 reviews on Google. Like, if it's a business that's not on Google Maps and it has like 17 reviews and, you can tell there's no pictures up, like that crap matters. So I would put energy into that. I would say the next two, and then we'll move on, is customer acquisition strategy. So Niki, on our first podcast that we did, we talked a lot about customer acquisition strategy, meaning if all of your customers come from route acquisitions, that's going to be less favored than if your customers are coming from, we've got an organic presence, meaning we've got SEO going, we've got pay-per-click going with Google, we use Thumbtack, and we use all these different things, and we have X amount of leads come in, and out of those leads, we convert X into customers. Like if you can provide that spreadsheet and that data, instantly the valuation starts going up in your business. It's one of the most important drivers in the business, and the reason why is because a person buying into the industry they can't buy reputation into the industry, meaning they're going to pay you for the reputation that you've brought into the industry, and you're worth more if you have organic growth coming into your business. And so that's going to be a valuation. If you're just like, it's just all referral, we don't know how we get people, it's just been referral, that's okay, but it's not something that the private equity group or the buyer can come in and grow. If it's just everybody's, and again, it's not bad. Referral is great. But if you have referral plus some organic engine, that's where the magic is. And then last but not least is your average customer tenure. So being able to pull up a chart and a spreadsheet, and this is the kind of stuff that you need to be doing now. Like before somebody comes and looks at your business, it's going to take you 3 months just to get all this stuff organized and get together. But if you could show tenure of your customers and go, 40% of our customers have been here for over 3 years, immediately the person that's looking to buy your business is going, oh, why? Like they can see it. If they can't see it, they're going to undervalue the business. So that's that bucket, services and customers. And then the last bucket would be what we'll just call the founder. I don't know another way to say it, right? Team and kind of culture. The founder, are you willing to stay on or not after the business sells and run the business? If you're not, the chances of your valuation being high is extremely low. If you're just like, I want to sell and leave, you're hurting yourself in valuation. If you want to have the highest valuation, it should be, I want to sell the business and I'll help and I'm willing to stay for a year, or I'm willing to take a new role as an employee in the bigger business. Any of those answers are going to drive you up the valuation scale. How old your business is, Niki? This is another one. A business that is 10 years or older is valued way higher than a business that's at 5 years or a business that's at 18 months. So here's what a lot of people are starting to do, Niki, is that they see, oh, private equity's in this industry. So now I'm just going to go buy a couple of businesses, put them together and sell it, right? And they think that's what's going to work to create the most maximum value. It can work, but it probably won't work anymore, because what they found is when you look at the data, the businesses that have been around for over a decade, those businesses, even if they're slower growing or even if they're stagnant, it's hard to kill them, right? It's really easy to kill a business that it's a young hotshot that owns the business for 12 months, buys some stuff, puts it all together, and then sells you the package. Make sense?
And I've even seen private equity firms buying these large established businesses and not rebranding them and keeping the name the same because they already have a great reputation in a local.
Absolutely.
Company.
Yeah. And I did it. I came in and did it to buy and go fast. I did it that way. And that was just my thesis, but I did it blindly. I had no idea. We were coming in 2021. No private equity money is even in the deal yet. And we started doing it. But the best way to get the biggest valuation is obviously to have a long-standing business, right? I'll give you just a couple more and we'll be done. Actionable M&A opportunities. If you get on the call with somebody who wants to buy your business and you say, hey, and I know 4 other people that I could go buy their businesses tomorrow, your business is worth more. And so having those actionable M&A opportunities is amazing. And then obviously strong values, culture. Like if you can tell us about, we have a weekly meeting and here's everybody that comes, here's our team. Our branding is the same. We all wear the same, the collared shirt. Everybody looks good. The trucks are branded. We have this cohesive unit of culture and values and all of these things. And you can prove it and show that and say, here's a copy of our team meeting that we had, or we do training every Wednesday or on Tuesdays and Thursdays. Here's our warehouse and we do repair tech training, or here's our pathway to growth for our employees. All of that stuff obviously increases value. And then last but not least in this category would be what we call key man risk. Okay. So the more the owner does in the business, the lower the valuation of the business. So if the owner is the repair tech, low valuation. If the owner is still cleaning, lower valuation. If the owner is running all of the business, that's okay, lower valuation. If the owner is just the owner and there's a president of the business in place and the owner's not involved in the business, higher valuation, right? So the more the owner does, the less valuable the business is. And we talk about that in skimming to scaling. So I've gone through the 5 buckets. the deal dynamics, the financial profile, the operations, the services or the customers, and then the founder and the team. This is what it takes to build a business that is full of value. And so, Niki, any questions or thoughts? I know we went over an hour on this, but I think it's worth it to kind of lay out this is what it is. And maybe we can turn this into a spreadsheet or a checklist or something where people can go, I can work on this. Any thoughts?
You can absolutely do that. What I will say is that, mindset matters. Mindset matters. I've met so many folks, and the ones that tend to float and to do well are the ones that are willing to take a risk, willing to let go of control, willing to get off the pole so that they can work on some of these things to improve their business. Kyle from Nevergreen Pools out of Sacramento, great example, right? Like someone who said, okay, I don't need to reinvent the wheel. I've been studying up. I'm taking advice from people who have done this a million times before. I'm trying to understand what private equity is looking for, and I'm going to build a business that is going to be attractive to private equity. I'm going to spend the money on marketing. I'm going to reduce my own pay so that I can put more money into the business. And he's rocking and rolling. I think there are great examples out there. My hope is that, if you're in this position and you're, if you got 100 pools or 200 pools or even 300 pools, or if you're just starting out, that you keep these things in mind as you're building out your business, because there are better ways to run a business. It's your business. You can do whatever you want, but thinking about the long-term plan and building a company that is valuable starts with you as the owner.
Yeah. And the last thing I'll say, if anybody's even listening to this, is all of these things we went through are boring and they're not sexy, and they're like the hard work of building a business that you don't hear a lot about. You know what we didn't talk about today?
What's that? Chemical
balancing of pools. We didn't talk about what wrench to use or what equipment is important. Like that, but it seems in the industry that's where like most of the content is around is about the pool, right? It's about the doing of the work. So the mindset here is that this is the chemical makeup of how you build a valuable business. So this is how we measure, is it right? Is the chlorine in line for your revenue, for your customer count, all of these kind of things. And so I would like to just offer my help. I've done it with many people. Casey at yummypools.com. Email me. We'll get on a call for 45 minutes to an hour. We'll walk through these things. We'll talk about it. If I can help you, I'll help you. If we can't help you, we won't help you. But, no harm, no foul, and just love to meet you.
Casey, I just want to thank you so much. The business expertise that you have amassed in your career and owning several very successful businesses, the fact that you're willing to take the time and share it for free with folks is so much greatly appreciated. When this industry rises up, when we all become more professional, when we all can feel confident in raising our rates and building healthy and sustainable and great businesses with opportunities for employees and career paths in this trade, everybody wins. So I just want to say thank you so much for taking the time to join us today. And I'm sure there will be more to come with Casey Graham.
Thanks, Niki.
Between Two Stops is brought to you by Skimmer. Save time, grow revenue, and deliver a seamless customer experience with Skimmer's all-in-one pool service management platform. Get started risk-free at getskimmer.com.